The shocking reality: $38.56 trillion. That's the current size of America's national debt as of February 4th, 2026. Not a forecast for next year, not an estimate analysts are debating. That's the live figure, growing at $74,378 per second. $6.43 billion every single day. If you believe that number has nothing to do with you, your income, or your savings, stay with me. Because while most people were busy scrolling feeds and streaming shows, the world's largest financial institutions began making a move we haven't seen in roughly 75 years. They've been reallocating serious capital, quietly, deliberately, out of dollar-denominated assets. No dramatic headlines, no emergency announcements, just steady, systematic shifts in positioning. And this is not speculation. The evidence is in capital flow reports, treasury releases, and institutional filings. The numbers are public. You can verify them yourself. Will you recognize the pattern while it's still unfolding? Or will you look back wondering how the warning signs were so obvious? The magnitude of global debt. Let's zoom out. Global debt has now reached $251 trillion as of 2024, based on the latest data from the International Monetary Fund. That's equal to 235% of global GDP, the highest level ever recorded during peacetime. Inside the United States alone, federal debt climbed from $36.1 trillion when the debt ceiling was reinstated in January 2025 to $38.56 trillion by February 2026. That's a $2.46 trillion increase in just 13 months. The debt held by the public now stands at $30.96 trillion, while intragovernmental debt totals $7.61 trillion. Here's what rarely gets discussed. This setup isn't new. In modern history, we've seen this configuration 3 separate times, and in each case, the nation controlling the world's reserve currency entered decline within roughly 36 months of major capital beginning to exit. Not loosely similar declines. Structured, repeatable sequences. Same progression, same pressure points, same end result. The pattern isn't emotional, it's mathematical. And once the cycle advances past a certain threshold, reversing it becomes nearly impossible. The 4-stage arc of empire collapse. Over the last 5 centuries, every major financial power followed a 4-stage arc before experiencing collapse. Stage 1. The rise. A nation becomes the hub of global finance. Capital flows in from every direction. Its currency becomes the backbone of international trade. Foreign governments hold it in reserves. Investors compete for exposure. Banks expand, markets surge, innovation thrives. Optimism feels permanent. This phase usually stretches across 50 to 80 years. Stage 2. Overreach. Prosperity creates confidence. Confidence turns into excess. Spending accelerates beyond sustainable levels. Military budgets grow, foreign commitments multiply, domestic programs expand. The belief that dominance will last forever begins to shape policy decisions. And how was all of this financed? With borrowed money. Debt began expanding faster than the underlying economy, but almost no one panicked. Why would they? Property values were climbing, stock markets were breaking records. On paper, everyone felt richer. To sustain the momentum, central banks injected liquidity. More credit, more stimulus, more fuel for the system. This phase can stretch for 20 to 40 years, long enough for an entire generation to believe the boom is permanent. Stage 3. The quiet shift. This is the turning point most people miss. It's not triggered by headlines or televised debates. It starts with balance sheets, with bond spreads, with capital allocation decisions made behind closed doors. Large institutions begin repositioning. No dramatic announcements, just steady reallocations into jurisdictions perceived as safer. Foreign investors trim exposure. Ultra-wealthy families move assets across borders. Sovereign funds rebalance. At first, it's barely noticeable. Then, the pace increases. Historically, this window lasts somewhere between 18 and 36 months. Stage 4. The breakdown. The reserve currency loses credibility. Foreign central banks begin unloading holdings. Inflation accelerates. Interest rates spike. Asset prices fall together. Banks strain under pressure. pension systems weaken. The middle class absorbs the damage. Political instability follows. And afterward, people ask the same question every time. How did we miss it? The truth is, the pattern was visible all along. Let me show you this cycle in action. Spain was the undisputed superpower of its era. No rival came close. Ships returned from the Americas carrying unprecedented quantities of gold and silver, wealth on a scale the world had never seen. The Spanish real functioned as the global reserve currency. International trade revolved around it. Madrid stood at the center of global finance. That was stage one. At the height of its power, King Philip II controlled vast territories across Europe. Spanish forces dominated land and sea. The empire stretched across continents. Money poured in from colonies spanning the globe. And what followed? Relentless spending. Conflicts with France, wars against England, battles with the Ottoman Empire, prolonged campaigns against the Dutch Republic, a massive standing military, expanding bureaucracy, lavish palaces, extravagant royal obligations. By 1550, government expenditures were running at roughly 300% of revenue. 3 times more was being spent than collected in taxes. The shortfall? Borrowed. From Italian bankers, from German merchants, from anyone willing to lend. But gold kept arriving from the New World, so confidence remained high. Asset prices inside Spain continued rising. The population felt prosperous. The empire appeared untouchable. Stage 2. Then, quietly, something shifted. By 1555, the shift had already begun. Major Spanish banking families started relocating assets to Genoa. The powerful Fugger family, among Spain's largest creditors, stopped accepting vague repayment assurances. They demanded settlement in gold. That wasn't confidence. That was an exit strategy. A year later, in 1556, prominent merchants began moving commercial operations to Amsterdam. Not overnight. Quietly. Opening satellite offices, redirecting trade routes, shifting inventory and capital piece by piece. Why? Because the numbers told the truth. Spain was functionally insolvent. At one point, the government was paying interest rates as high as 40% on certain loans. 40% is not the price of strength. It's the price of desperation written into the financial record. Stage 3. Then came the defaults. In 1557, Spain failed to meet its obligations. Credit markets locked up. Government bonds collapsed in value. Private gold shipments were seized to fund the military. The financial system destabilized. Officials insisted it was temporary. It wasn't. Defaults followed in 1560, again in 1575, again in 1596, again in 1597. 4 sovereign defaults within 4 decades. The currency deteriorated. Inflation crushed purchasing power. The middle class absorbed the damage. By 1600, Spain was no longer the unstoppable empire it once was. The golden era ended. Capital didn't disappear. It relocated northward to the Dutch Republic, and history was about to repeat itself. The Dutch East India Company reached a valuation equivalent to $8.28 trillion in today's dollars, larger than Apple, Microsoft, Amazon, and Google combined, and then doubled. Dutch banks financed global commerce. The Amsterdam Stock Exchange pioneered organized equity trading. The guilder became the dominant reserve currency. International settlements required it. Capital poured in from Asia, Africa, the Americas, and across Europe. If you compressed today's financial hubs into a single district, that was Amsterdam in its prime. Stage 1. But prosperity once again led to overreach. A series of conflicts reshaped the balance sheet. 3 Anglo-Dutch wars between 1652 and 1674. Additional wars with France and Spain. Military commitments stretched from Indonesia to Brazil to South Africa. War is expensive. Government debt rose from 4 million guilders in 1650 to 80 million by 1690, a 20-fold increase in 4 decades. To sustain it, monetary expansion accelerated. Meanwhile, speculation exploded. During tulip mania, rare bulbs traded for sums exceeding the value of houses. Some sold for 10 times a skilled worker's annual income. Asset prices detached from fundamentals. The Bank of Amsterdam, long viewed as Europe's safest financial institution, was secretly lending depositor funds to support state obligations. Fractional reserve practices without transparency. Stage 2. By 1690, informed capital began migrating. Banking families shifted operations to London. Sephardic Jewish merchants who had helped build Amsterdam's commercial dominance relocated. Portuguese traders opened English branches. German financiers reduced exposure. They saw what the public did not. The Bank of Amsterdam had been insolvent since 1672, effectively using new deposits to satisfy earlier withdrawals. The illusion held until it didn't. Stage 3. In 1795, French revolutionary forces entered the Netherlands. The Republic collapsed. The guilder failed. The bank's fragility was exposed. Depositors suffered massive losses. Social unrest followed. A century and a half of dominance vanished within years. Capital moved again, this time to Britain. The pattern was accelerating.